Ladies and gentlemen, good day and welcome to the PG Electroplast Limited Q3 FY23 earnings conference call hosted by PhillipCapital India Private Limited. During this call, the company may make certain forward-looking statements based on the currently held beliefs of the management of the company, which are expressed in good faith and in the management's opinion are reasonable. The forward-looking statements may involve known and unknown risks, uncertainty, and other factors which may cause the actual results, financial condition, performance, or achievements of the company or industry to differ materially from those in forward-looking statements. These forward-looking statements represent only the company's current intentions, beliefs, or expectations, and any forward-looking statement speaks only as of the date on which it was made. The company assumes no obligation to revise or update any forward-looking statements. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Deepak Agarwal from PhillipCapital India Private Limited. Thank you, and over to you, Mr. Agarwal.
Thanks. Good afternoon all. On behalf of PhillipCapital India Private Limited, I welcome you all to PG Electroplast Limited Q3 FY23 earnings conference call. Today we have with us senior management represented by Mr. Vishal Gupta, Managing Director of Finance, Mr. Vikas Gupta, Managing Director of Operations, and Mr. Pramod Gupta, Financial Officer. Without taking much of time, I would like to hand over the floor to the management for their opening remarks, post which we'll open the floor for Q&A. Thanks, and over to you, sir.
Thank you, Deepak. Good evening, everyone. Thank you for sparing your valuable time and joining this call today. Hope all of you are doing well. I'm joined on this call by Mr. Vikas Gupta, our Managing Director of Operations, and Mr. Pramod Gupta, our CFO. We have already shared our results presentation earlier and hope you must have gone through that. 9 months of FY23 has been another milestone for PG, with significant growth over FY22 numbers. Revenue grew 121% and crossed 1,320 crore rupees, with products business leading the show with a 55% share. EBITDA increased by 153% and stood at 103.5 crore rupees, and net profit rose 281% with 37 crore rupees. Product business crossed 720 crore rupees in the first 9 months of FY23, with room AC business contributing 497 crores, which is a 431% year-on-year growth. The washing machine business for the 9 months had a YY growth of 80%, with the company selling over 360,000 washing machines in the period. Order book for product business remains robust, and the company is on track to scale the product business significantly in FY23 and FY24. This year's capacity expansion projects have already concluded and begun mass production. Capex guidance for FY23 is being maintained in the range of 135 to 140 crore rupees, and company has already doubled its washing machine and air cooler capacity, while also further expanded room AC capacity to 200,000 indoor units per month and 100,000 outdoor units per month. And the new PCB assembly facility for RC controllers in our Supa factory has also begun mass production. We are also increasing our sales guidance to at least 2,000 crore rupees, which is a growth of 82% over FY22 consolidated sales, and operating profit guidance of at least 140 crore rupees, which is a growth of 88% over FY22 operating profit of 74.5 crores. PG's new product offerings in washing machines and room ACs have received very good response from the customers. The company is focusing its efforts towards developing the products that help it maintaining cost leadership while also striving for product leadership. Company continues to see increased interest for business from new existing clients and we remain very confident on the future growth prospects of the business. With this now, I like to hand over the call to our colleague, Mr. Pramod Gupta, our CFO, to elaborate on the financials.
Hello and good afternoon, everyone. I am sure all of you have seen the financials in details already. We had a very good scale-up during the first 9 months from operations point of view. The net sales for the quarter are up almost 75% at 457.9 crores. EBITDA grew 114.3% at 38.17 crores, and net profit rose 148% to 17.4 crores. During the period, operating margins have improved due to cost control, also due to lower commodity prices and operating leverage, which has kicked in the AC business especially. On balance sheet side, I want to highlight that we have had a debt increase of about 1.36 billion rupees, which is 136 crores in the first 9 months, largely due to completion of capex, which was funded by the debt and also partially by the debt, and also increase in working capital. This increase in working capital has happened largely because we pulled up some of the inventories for the strong AC season which we are expecting, and also because there was a murmur in the month of November, December that China may open up completely, which they did finally, and we were suspecting that it could lead to some problems later on, which did not happen incidentally. So we actually pulled up some inventory, and that has led to some higher working capital during the last quarter. I want to highlight here that the debt increase has largely been on account of working capital debt. In fact, if you will look at it, from the long-term borrowing has actually increased quarter on quarter by only 29 crores, while the working capital debt has actually increased by almost 68 crores during this quarter, and that is largely because of this inventory pulling up issue, as well as very sharp ramp up which we had in the months of in the AC business in the month of December. Also, because we are increasing the guidance to 2,000 crores, we will be having a little higher than expected or initially budgeted working capital for the full year, and that's why the debt is looking higher. But we hope that over the next quarter, the working capital cycle will improve further from here. With this, I open the floor for question answer.
Thank you. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bala Murali is an individual investor. Please go ahead.
Yeah, good afternoon, sir. Congratulations, good set of numbers. So I would like to know about the long-term view of the company over the 4-5 years horizon, by assuming that the industry will grow at a significant rate. So, in what kind of position we can see the company in 4-5 years horizon?
Let me tell you, see, for next 4-5 years, I can give you a very general statement in the sense that company have a very strong conviction in India growth story and India consumption. As an economy grows and the per capita income improves and purchasing power improves of the people, the consumers, then the products what we are dealing in, incidentally the penetration levels are very low in India market, and there is a very big and vast potential of the growth. So we see a very strong potential in the growth, which is actually supported by the government policies, where the government is now pushing for import substitution and is ensuring that whatever is being sold in India has to be made in India. So all these factors, import substitution, government policy supports, PLI schemes, and the general growth in the Indian economy and the growth in the per capita and the purchasing power of Indian consumers will actually lead to a very secular growth for next 4-5 years. That is our strong belief, and that is why company is preparing itself for this growth opportunity. Company is heavily investing in the capabilities and the capacities to take benefit of all such opportunities which may arise in future.
Yeah, that's great. And one more thing I want to know about the FY24, any capex plans already made, and any new products we are going to introduce, or any backward integration?
In FY24, see, we will be doing a capex of 125 to 130 crores. That is the basic capex what we have planned right now. Company is looking at new product categories also. As and when those projects materialize, we will further update the market on that. As the capex guidance is around 100 to 150 crores for FY24. As and when new product categories or anything which is being discussed internally, something firms up, we will update the market on that.
Yeah, thanks. And lastly, on any revenue guidance for FY24, based on this capacity almost doubled for air conditioner and washing machines. So what can I expect?
Yeah, FY24 numbers are being worked up right now internally. It will take another 3 to 4 months to firm up those numbers, and we will be sharing those numbers maybe in the June quarter. We will be sharing those numbers. And
yeah. That's it. Thank you. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1 on your touch-tone phones at this time. Participants who wish to ask a question may press star and 1. The next question is from the line of Karthik Jain, an individual investor. Please go ahead.
Yeah, hi, Mr. Gupta. Congrats on a great set of numbers. I have a couple of questions on your...
Can you be a bit loud, please, Karthik?
Yeah. Is it better now?
Yeah, better.
Hi, congratulations on a great set of numbers. I have a couple of questions on the TV business. I think your TV business has grown significantly in this quarter. I think it represents about 12% of the overall revenue for this quarter, as I can see in the presentation. So can you just put some more light on that business, how the growth prospects are, and how are you planning to increase that business?
Vikasji, will you take this question?
Yeah, Karthik. So TV business is something that we re-entered only a year back. The TV business is not more than 12 months old for us. So we were at a small base in FY22 as compared to that. So FY23, definitely numbers are looking, the growth is looking impressive. But because the base for the FY22 was very small. And going forward, we feel that again we are confident that in the TV segment as well, the business for us should grow. We are discussing with various clients, regional and the national level brands for the TV manufacturing for them. So I think going forward, the TV business will also grow in FY24 as well.
Okay. And regarding your AC business, so the majority of the capex that you're doing is for which product line? Is it for the ACs? Is it for the coolers? Is it for the TV units? Or like, can you just give us some more details about where the capex is really going?
See, the majority of the capex has been done for AC business and washing machine business.
Out of the total 130 crore capex till now, which we have done, almost 90 crores is for AC business, and about 30 crores is 25 to 30 crores is for washing machine, and rest is for the component.
Okay. Got it. Okay. Thanks a lot. And best of luck.
Thank you. The next question is from the line of Abhineet Anand from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. First, I want to understand what was our overall utilization in the REC part in the first 9 months?
Utilization is difficult, especially because we do not maintain the utilization on a monthly or quarterly basis in the company. But I can tell you that in the off season, typically the utilization level falls very badly. And last quarter, if you see for the whole quarter, the AC business had a total turnover of only 50 odd crores, while this quarter that has moved up significantly because of the month of December itself only. And the current utilization levels till March are likely to be in the range of 85 to 90% in the AC business. But after March, we will be able to comment only how the tertiary sales actually take place. So on an overall basis, typically in AC business, 55-60% is the capacity utilization, which is optimal as per our experience of last year that we see happen over a full year.
Yeah, I understand that because of the seasonality, the utilization will be low, maybe 50-60%. So what is this 80-85 that you talked about, sir?
Right now, the utilization on the total expanded capacity.
You are saying 4Q?
Yes.
Second is, from your understanding on the, in REC market, have you seen, demand coming back? Majority of the brands are still looking. What are they expecting in terms of the upcoming summer?
See, right now, as everyone knows, right now it's a primary sales which is happening. In the sales, the brands are pushing material to their dealer and distributor network. Tertiary sales or secondary sales will start happening from the 3rd or 4th week of March when some summer sets in the South India. It starts from there, South India. So as of now, people are expecting good season, good summers. But if things will, come more clearer, and we will have better picture once by 3rd or 4th week of March only. But as of now, as industry as a whole is pushing for good growth this year.
And in the AC industry, from across brands, we understand that looks to be slightly, quite a bit of competition there. There are players which are probably trying to gain market share through aggressive branding, aggressive pricing, which has been prevalent for last few quarters. As of now, you feel that situation is continuing or any, subjectivity around that, if you can throw some light?
See, we can share our limited information on knowledge with you on that, but there are certain brands who are aggressively pursuing market share gain strategy, and once they are doing that, so they will have to be aggressive on prices and be aggressive on advertising and other things, so that they are able to increase their market share. That is there. So some brands are trying to do that. We are seeing that thing in the market.
Okay. Lastly, from REC itself, of this around 500 crore of sales in 9 months, this consists of REC plus components, right?
This is purely REC sales.
REC product sales.
Product sales.
Any components.
Yeah.
And where does the components lie?
Components lie in the plastic molding business.
Okay. Thanks, sir. I will come back in the queue if I have more questions.
Yeah, please.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. The next question is from the line of Pranay Roop Chatterjee from Burman Capital. Please go ahead.
Hey, good afternoon to all present. Am I clear and audible?
Yes, sir.
Great. My question was regarding the washing machine segment. Firstly, apologies if I missed the volume number in the presentation. If you could just disclose. I think the volume is given. That's great. Regarding the washing machine demand environment, if you could just give a few comments on how the demand is shaping up and how you are scaling up in the different segments, which is semi-auto versus auto. And any comments on your market share movement in the last quarter?
Yeah. So, volume side, I'll just clarify. In the first 9 months, we have done about 3.6 lakh volumes till now, and in the third quarter, we did about 111,000.
Yeah. Okay. So when we talk about the forecast for the near-term period, I think the market sentiment is looking quite strong. The kind of forecast or the kind of roadmap that we have from our clients, we see a sharp pickup in the demand for these washing machines from June onwards. Typically, the high season for washing machine starts with the onset of the monsoon, and it starts picking up. The Diwali is one big season for washing machine sales. Then there is a sales happening during the winters also. So it will start tapering off from the month of December onwards. So what we see as of now, we are in discussion with our clients, and we see a strong growth for the washing machines as we have already doubled our capacity. That is based on certain assumptions, on certain discussions with our clients, where we are seeing a further ramp up of the volume with the existing clients, where we are seeing an increased share of wallet from their side, and we have added quite a few new clients also as well.
Got it. And could you please give the volume of ACs in this quarter, IDU versus ODU?
Yeah, that I'll just share with you. Just a minute. The IDU number is about 193,000, and outdoor unit number is about 62,000.
Great, got it. And did you receive any state incentive this quarter?
No, this quarter, yes, on the older investment in the parent company, PGEL, we continue to basically receive the state incentive.
See, we are in the process of completing our investment in PG Technoplast, the wholly owned subsidiary in Supa, and we already have an in-principle approval from the government of Maharashtra. We will make our application in FY24 after completing our investment and apply for those benefits. In the parent company, which is there for last many years now in Supa only, we continue to get those benefits from the Maharashtra government.
Got it. And I have just one last question. You reported 7.8% EBITDA margins around that this quarter. I just wanted to check in case there was any one-offs in this margin.
No, there is no one-off. Actually, last quarter, if you see, we had a negative operating leverage of the AC business because we had a small loss in the operating in the AC business because of the seasonality. This quarter, all the businesses had a profitability and operating leverage turned on the positive side in the AC business.
Got it. In case I can squeeze in one more question, your net debt is around 470 crores right now. By Q4 end, would you expect it to go up or down?
No, we have already given a guidance for the full year. That is likely to be probably in the same range or maybe 10-20 crores plus minus, I'll say. The reason is that we are having a very high inventory level for the season, and we actually are hoping that receivables we will be able to control. Most of the capex is already done, so the working capital loan should probably be in the same range, and we do not foresee any increase in the term loans.
See, what happens because of the last quarter, we have such a sharp ramp up in our sales. So working capital or numbers will look little tweaked. In fact, by June end, those numbers will start normalizing. So, but in March end numbers, you will see at the similar levels what we are seeing right now.
And do you see an increase in interest cost? Would that have contributed?
No. Interest rates, we are getting our market rate only about 9% of the cost of borrowing. And if obviously the bank rate increases, then we will see probably some increase.
Got it. Great. Thanks a lot for answering my questions.
Thank you. The next question is from the line of Tina Virmani from Kotak Institutional Equities. Please go ahead.
Hi, sir. My question is regarding the pricing strategy that you mentioned about certain brands which are aggressively pursuing this market share gain. Now, this could be a near-term scenario that we may see, but how do you see the long-term realization movement for both even the AC players and the ODM players moving out, given that there is a scope in the industry also to grow and everybody is also expanding capacity. So how would the situation pan out over a slightly longer period of time when the capacities are in place and realization for both AC players as well as ODM players like you and other players in the industry?
So, hi Tina. So you are trying to put up two questions: how the brands are going to play in next 2-3 years, and how ODM people like us are going to play in next 2-3 years once the capacities are in place and they are fully operational, right? So see, it will be very difficult for us to really, answer the question from the brand's perspective. But as per the information or the knowledge that we gather from the industry people, there are certain brands who have a very aggressive market share gain strategy. That is why they are pursuing those aggressive pricing, and they hope to follow that for at least this season. They are hoping to follow this strategy. In case of ODM players like us, being a seasonal business, I will tell you, it's very, very evident. The brands, the people who are putting up their factories, and some brands are also putting up their factories, and some ODM players are also expanding their capacities. But being seasonal in nature, the pricing, there is not much of the pricing play in the ODM sector, in the sense, because when clients are buying a product of 20,000 rupees from any ODM player, so anything, any 100, 200, 300 rupees difference doesn't make much of, impact to them. They are actually focusing more on timely delivery and quality. So quality and delivery is very, very important. Cost is exactly, not exactly means it's an industry given. It's a buyer's market. It's not a seller's market. We agree on that. But let me tell you that 200, 300 rupees on a 20,000 product doesn't make much of a difference, provided your customer can derive comfort from your capabilities of delivering a quality product on their time, as and when they want, and the flexibility is there. So, I can't answer this question in a very, simple manner. So that is the way I have given you this explanation.
So even on a longer term basis also, this may remain less similar to what all the ODM players are currently getting from the brands.
So Tina, I will tell you what strategy as a company we are trying to follow. We are trying to follow a cost leadership. We are trying to, the plant that we have put up in Supa is the most backward integrated single location plant and one of the largest single location AC manufacturing facilities in India right now. The basic idea is to derive cost leadership from all the synergies. If you are making all components in-house and you are not spending money on packing and forwarding of those components to make ACs, that is one thing. That is what we are trying to do right now. So if we are able to drive cost leadership at one point, and second point, what we believe as a team, what we tell our team members, actually we are not selling any product. We are selling a service. What product we are offering is not much different from the product being offered by our competition. But what can differentiate us from our competition is the kind of delivery or kind of service we are able to offer to our customers. And that is why we are able to increase our market share in this competitive scenario because of the service aspect of this business, what we are trying to highlight.
Okay. So what would be your current market share or maybe FY23 closing market share approximately in the among the ODM players if one were to analyze that?
I won't like to speculate on those numbers because it's a very early, it's a second year of operations only for us. So I don't think we will not be in the right position to answer this question right now.
Got it, sir. No problem. And one last question is on the incremental margin benefit that can come through from your new capacities, which are primarily led by this PLI capex. So without taking into account any PLI incentive, what could be the delta gain and margins that you can accrue from this entire backward integration expansion that you already have done?
Margins are likely to be largely in the same range as they are because some of the benefits that we have talked about of backward integration are largely there, and we don't focus so much on the margins per se. Although we are, as Vishalji explained, we have a clear focus on cost leadership. The whole focus of the organization is to actually increase the throughput and actually have a much better asset turn. So actually, I keep on telling this to all the investors, and I'll repeat again for the benefit that in our business, margins are actually an outcome of many of the things. One of the very big important thing is actually the commodity prices during that time. Now, in this quarter, we had slightly lower commodity prices that actually are helping the margin percentage. Although whatever money we get to make an AC as our gross contribution is actually very similar to what we were getting last year or in the last quarter. That has not changed. Second thing is, if we can actually increase our asset turns and do more throughput from the same plant, that is actually going to let us actually give us much more advantage than actually focusing probably of 10-20 basis point of margin, and that is what has been our strategy. If you look at in our case, we have probably invested close to till now 200 plus crores, and in the very second year, we are expecting a turnover in the AC product business of almost 900 plus crores, which is our asset turns of 4.5, which we think is very, very good in contract manufacturing business like ours. And that has been our strategy on all the product side, where we are working only and focusing to increase the asset turns, asset throughput to improve our ROC, and not actually very, very focused on the margin percentage per se.
Okay. And when your other segments apart from washing machine also, when they start expanding, let's say for example, if TV, if it expands, then probably your asset turn can improve further?
Yeah. So TV actually is a very small business as of now for us. Only this year we'll probably do close to 150 odd crores. As and when TV and washing machine percent, the overall asset turn in the company, and therefore the ROC will see a further improvement going forward.
Got it, sir. Got it. Thank you so much.
Thank you.
Thank you. The next question is from the line of Vaibhav from ICICI. Please go ahead.
Yeah. Hi, sir. Akhilesh here. So, firstly, you mentioned that for the full year, you expect the net debt number to broadly remain at the current level, 10 or 20 crores, perhaps slightly higher. So, what is your assumption regarding the receivable level at the end of the year? Because what we have seen in the last 2 years especially is that the receivable in terms of number of days also goes up in the last quarter. So, what is that assumption which you're making?
See, what actually happens is, in the last 2 years it happened was that fourth quarter was a very big quarter in comparison to, and that also happens because of seasonality. Hello?
Yes, sir. You're
Yeah. Go ahead.
Yeah. So that happens because of the seasonality, and as well as in last 2 years, the first half in both the years got marred by because of the COVID issue. This year, that challenge is not there. Although, nonetheless, the fourth quarter is going to be relatively larger. We have given a guidance of almost 680 odd crores in the fourth quarter, with 1320 crores in the first 9 months. But nonetheless, it is not as skewed as last year or year before that. So overall, on a monthly basis, we don't see that kind of a shoot up which happened in the previous 2 years. So those numbers will not look that acute in terms of days receivable. But nonetheless, I will tell you, what happens is that monthly run rate has actually significantly changes in the fourth quarter. So in the first 9 months, if you see, our monthly run rate is of the order of about 140 odd crores or 145 crores. And now we are expecting close to something like 230 odd crores of a run rate in the next 3 months. So obviously this run rate leads to about, even if you assume 45 days of a of a receivable situation, then 230 into 1.5, that will come to something like 400. No, 345 crores or 350 crores is the kind of number which you will see on the receivable side. But we are working towards many aspects so that to control as receivables as well as inventory, and hope some of those things will actually work out.
Okay, so you remain confident that if, let us say, we have reported around 40 or almost 50 days of receivable in the at the end of the current quarter, so that will go down to around 45 days.
Yes. Yes.
Okay. And sir, I don't know if I missed this, if you have already given it, but what is the volume for the LED TVs? I know it's a small part, but what is the volume in this quarter?
Just give me a second, I'll let you know.
Yeah. And sir, in the meanwhile, if you can also speak about the customer addition, washing machines and LED TV business which you are expecting.
So we don't disclose individual client names in our customer list, but we are on the verge of adding 2 very large customers, national brands, which one of them has already going to start mass production in this month, and one more customer product approval is already completed, and we expect to start productions in the month of April for that large customer also. In case of washing machine. In case of TV also, we are discussing with a lot of customers, and we are trying to add those customers as and when, we are developing our ODM products in TV category now. So we'll be adding some more customers, but right now we will not be able to disclose the names right now.
And sir, in washing machine, the customer addition, the 2 national brands which you spoke about, this will be this will be for the semi-automatic category?
Yes, sir.
Okay. And sir, based on your guidance, so you're expecting the full year margin to be around at the EBITDA level to be around 7%. So is this the sustainable level which should assume, or do you think this has further scope to inch up, in the in FY24 and FY25?
Yeah. So coming back to your TV question, this quarter we had about 40,000 volumes in the TV in the quarter in the sales, and actually margins is an outcome of many things, and how in the quarter, what is the mix of the segments, that also decides the margin apart from individual segment level margins. So it's always very difficult to pinpoint the margins in the quarter, but we hope that because of the improvement in the revenue outlook across all the segments, the margins should be slightly better in the coming quarter in each of the segments. But final margin will actually totally depend on the overall mix, and that mix we don't know as of now today. It will actually be visible to us only in the month of by the month of end of March. Nonetheless, because of the scale initiatives and also because of the operating leverage, we are very hopeful that margins in the coming quarter will improve further in each of the segments.
Got it. And sir, by the end of next year, what kind of debt reduction you're expecting overall from the current level?
I'll tell you very frankly, if we do not add any new product segment, then we should see some amount of debt reduction surely next year. but we are actually considering some new products, and if we take any decision on that, then we may have to do some CapEx, further CapEx on those new product lines. But in the existing product line, as of now, whatever the business plan is there, we think 130 plus minus 510 crore rupees of CapEx is going to be there, same as this year. And next year, our EBITDA and other income should be significantly higher than this year, and that should help us to actually do some debt reduction for sure. Those numbers we will be able to share with you once we finalize the plan, business plan for the next year, sometime in May, after the fourth quarter results.
Got it. Thank you, sir. I'll get back in the queue.
Thank you. The next question is from the line of Srinidhi from HSBC. Please go ahead.
Yeah, hi. Thank you for the opportunity and congratulations on good set of numbers. Sir, I have a question on margin first. If I look at your margin at about 7%, it looks very impressive, particularly given that one of your close peer, Amber, has reported quite a weak margins. So your assessment, what is really driving the superior margin for a PG Electroplast, given the size of the company is smaller?
See, as Vishalji has been telling that we work a lot towards cost leadership. And also, please appreciate, we are a multi-product company and we have a wider portfolio which allows us to weather the seasonality of these businesses much better. And therefore, the operating leverage that actually works into the negative in the off-season is mitigated to some extent in the portfolio because of the other products, helps us to actually report slightly better margin. But I think on an overall product business margins for us, Amber, ED must be in the same range. This is my best guess, at least in the season. In the off season, actually, because of the operating leverages that play out for different players, because of the portfolio of products, they may have a different impact. And that is one of the reasons because of which probably we may be reporting slightly better margins in our opinion.
And sir, you also highlighted that you probably have a largest single location manufacturing plant for AC and probably closer to ports. Just wondering how much does that help in terms of having a better cost economics?
No, it does surely help, but more important than the nearest to the port, it is actually the single location and having all the units for all the components with the single location and under single roof. Actually, that leads to little bit of saving in terms of transportation, logistics, as well as the packing and some of the other costs, which in our opinion may be to the tune of maybe 0.4-0.5% at best.
Right. Yeah. And one more question from my end on margin. So if you look at your guidance of about 7% margin in FY23, may I ask how is it different between product business and your rest of the business?
So I'll just give you some basically broad ballpark margins on each of the segments that we have, and this is what we have seen over a slightly longish period of time. Typically, the product margins are between 7 to 8.5%, depending upon the mix of the products. Washing machine has a slightly better margins than AC, and actually cooler has the best margins. Cooler margins are almost in the double digits, lower double digits. But cooler is very highly seasonal. It is only a 4-month product, and it's a very small segment for us now. In the plastic molding business, the margins are 7% plus minus 0.4-0.5% is what we have seen over a longer period of time. And in the TV business, which is a new business, but we have estimated it is around about 1.5 to 2% at best is the margin at the operating level which we make. In the mold making or all the tool making, the margins are anywhere between 25 to 35 depending upon the deliveries in that quarter. These are the broad ballpark margins which we have seen in our different segments.
Right. That is helpful. And last one, sir, from my end. So you're guiding about 900 crore of business revenue from AC products, right? For full year 23. May I ask how much is it coming from your own design product?
It will be almost 80% plus will be from our own ODM products.
Right. And it includes inverter air conditioners as well, right?
Yes, it includes both inverter, fixed speed across all the categories, 1 ton, 1.5 ton.
Right. Thank you for answering my question and all the very best.
Thank you. Thank you very much.
Thank you. The next question is from the line of Harsh Saraswat, an individual investor. Please go ahead.
Hi. Good afternoon for taking my question. My question is in a broader context. Competitors are seeing slowdown in mobile segments, and I wanted to understand that, does that helps you gauge a pattern of, demand in our segments also? Can we also see a slowdown going forward in the year?
Actually the behavior of the market is different in both, mobile phone products and the consumer durables. If you see industry penetration, the product penetration, mobile phone and LED TV still have a very good penetration in India. Maybe 70-75% penetration is there of mobile phones and LED TV. But the product categories like AC, washing machines, the products what we are trying to, aggressively push and try to make it as our growth driver, the penetration levels are very low right now in India. So what we feel that with the income levels improving and overall electricity availability and all those things helping, we see a very good growth potential for next 4-5 years. So we have a very strong conviction that this product categories where we are trying to put our focus, they will have a very good growth in times to come.
Got it. And one more thing, if you were to point out few risks in the business, what would they be like?
Sir, business is trying to grow. We are trying to grow business very fast. So execution is something which is very important in our business. Let me tell you, in the business contract manufacturing, actually, there is very little risk because you get very clear forecast from your customers. You don't really go for big time or you make any big blunders. You are able to meet their requirements. You don't see any major challenges in this. But execution is something very important day in, day out because business is so competitive and margins are like wafer thin. So you have to be always on your toes, focusing on cost leadership, trying to do loss elimination in your plant. That is a continuous focus. So that you remain relevant all the time. You are able to maintain your cost leadership. That is the focus. And that is the actual risk what we have to keep focusing on day in, day out.
Got it, sir. Thanks. All the best for the future.
Thank you.
Thank you. Participants who wish to ask questions may please press star and 1 at this time. The next question is from the line of Ashish Kumar Singh, an individual investor. Please go ahead.
Congratulations on your good set. Previous participants have asked for the LED TV numbers, so I wanted to get those.
40,000 for the quarter, and for the first 9 months, the total number is about 80. Just give me a second, I'll exactly tell you.
Yeah. And other than that, I wanted to get your comment on the raw material cost that you have said that they have reduced in the past months. So what do you think, will they will be lower in the coming months or?
Yeah, so for the first 9 months, the number is 80,500 in television, and in the last quarter, the number was 40,000.
Okay.
Now coming back to the commodity price, it's very, very difficult to forecast these commodity prices, and they are dependent on many factors which are beyond our control. We are actually a price taker in that market.
Okay.
And some of the commodities which had softened significantly in the last quarter have actually started moving up, especially the base metals like aluminum, copper, etc. in the recent weeks. In fact, in the last 4 weeks, there has been a significant movement upward in both copper and aluminum, and it will be reflected. It is a pass-through for us, maybe with a lag of a month or so. So it will be reflected in our pricing in the coming month.
Okay. And I wanted to ask, you have mentioned that the inventory has gone up in the last quarter, and I can see that it's around 350 crores. So is that inventory on a lower cost or against right now, or is it higher than right now?
See, it is actually the copper and the aluminum inventory that we are carrying we were carrying at the end of December, because there has been a significant production also in the month of January and till now in February, was at a lower cost, but we don't cover ourselves for more than about 1.5 to 2 months in the inventory. Now the prices of the raw materials which we are purchasing are at the market prices, which is at a higher price than what we were having in December.
Okay. And so I think the margins should improve in the next quarter for the previous inventory, right?
No, the issue is this, that the pricing also happens with the lag. It is not immediately that you are able to, yesterday the price increase and you will tell your customer that you have to give me a higher price tomorrow. It doesn't work that way. In our business, the contract manufacturing, the prices actually get reset every 1 month, 2 months, or 3 months, depending upon the contract. And then according to those contracts, we try to cover ourselves on those inventory. We don't take a active call on prices of inventory by holding copper and aluminum. On the contrary, like whatever orders we have at a price, we try to cover ourselves to that extent in with those commodities. We don't actually take a call at all on the prices of commodity.
Okay. And the last question is, what is the order book or the interest that you're seeing for this summer season in AC business?
Till March, we have a very strong order book. Whatever our capacities are there, they are all booked out. And we have orders beyond March also, but I will keep my fingers crossed, because those orders will start to materialize only if the tertiary and the secondary sales are good beyond March. So till March, I can tell you that we are running at almost 90% plus capacity utilization, 85-90% capacity utilization on the expanded capacity in the AC business.
Okay.
So April onwards, what will happen, the production numbers for us may be 20% higher or 20% lower, depending upon the secondary sales, which will start happening from the 3rd and 4th week of March. Once we have those numbers, then we will be able to give you a little better idea, but the numbers will not change much. It may be plus minus 20%.
Okay. So that's all. Thank you so much for the opportunity.
Thank you. That was our last question for today, ladies and gentlemen. I now hand the conference over to the management for closing comments. Over to you, sir.
I want to thank all for participating in the call, and I want to reiterate once again that please don't look at the percentage margins in this business. They are actually an outcome not of the business mix as well as the commodity prices in that particular quarter. Our focus is totally to just push more throughput from the same investment which we have done, and we will be focusing actually much more on getting our asset turns rather than margins. Margin percentage is actually very irrelevant in our business, in our opinion. With this, I'll actually thank you all, and I will invite if any of you want to visit our plant, both in Supa and Noida, please feel free and mail to me or my colleagues, and reach out to us, and we will make the arrangements. Thank you very much.
Thank you. On behalf of Phillip Capital India Private Limited, that concludes the conference call. Thank you for joining us. You may now disconnect your lines.